Well, let's get across the market open now. Kyle Rodder joining us from capital.com. Kyle, welcome back to you. Lots to get across overnight. Let's begin with those developments in the Middle East. Oil prices surging some 8%, Iran and the US resuming those hostilities.
Yes, and it sort of seems that these issues between the two countries are basically intractable. And I mean, I think there's some internal divisions, obviously, within Iran as well, where, we're getting some of the more moderates speaking about the prospects of negotiations, or at least that's coming out in sort of the news media. But of course, the IRGC and some of the more extreme elements of the Iranian regime have been more or less responsible for some of these strikes on US bases in Jordan. We've seen retaliatory strikes as a result between the US and Saudis on Iraqi soil, obviously Iranian aligned assets there. And then, some of the big comments that came out towards the end of US trade last night from Donald Trump was that effectively the United States plans to hit Iran hard once again. And we're in this cycle of escalation once more without much of a prospect, it would seem, of a peace deal that will get the Strait of Hormuz reopened again and, will diminish some of these geopolitical risks, which really center at the moment around the possibility that this will result in a targeting of energy infrastructure once again, or at least maybe even a sort of another chokehold, or I should say choke point, in the Middle East in terms of the Red Sea being blocked up because of, a widening of this war. So oil prices rebounded really aggressively, up 7 or 8%. And, for the most part, it was probably really what weighed on Wall Street more than anything else overnight, notwithstanding, obviously, the other very significant event risk that investors had to digest.
Yeah, so when we take a look at, well, not just obviously what's going on in the Middle East, but also that feeds into how central banks are trying to navigate their path forward at the moment, given that volatility, the inflationary effects of oil prices. And of course, we did hear from the Fed overnight, leaving rates on hold as expected. Mind you, there was some dissension there.
Yeah, it was a 9-3 split with, three members voting to hike. And I think, it was quite appropriate that, market pricing was at around 28% chance of a hike going into the meeting. And, that's sort of kind of what we saw aligned on the FOMC as well, which is, call it 25% of the committee thought it was time to raise interest rates. But I mean, I think what markets really took away from this was that, the Fed's really not going to tell us much. And you sort of spoke there about how central banks will navigate the inflation caused, obviously not just by oil prices, but some of these strong underlying inflationary pressures there as well. And there was very little substance, true to form, and as we're starting to get used to from Walsh, when it comes to, guidance where policy could head from here, and the Fed's reaction functions. So I think what we really saw was a market, first of all, reacting to the fact that we didn't get a rate hike. So that's sort of 30% came out of, or 30% implied probability of a hike at this meeting came out of the market, and that was a brief boost to equities. But there was also this kind of move in the markets where the odds of a September rate hike have been diminished slightly. And I think that's because we're seeing that Walsh isn't perhaps as hawkish as some had feared. And although there has been this kind of reassurance, and it was repeated again last night, that the Fed is laser focused on getting inflation back to 2%, there hasn't been any sort of indication yet that the Fed is going to take those steps to increase interest rates to get prices back to around that 2% target. So, as a result, we actually saw throughout the Fed decision, a jump at the decision itself in equities, a jump throughout the press conference when Walsh was speaking. And it was probably other things that really dragged on equity prices to see Wall Street end up so dramatically lower overnight. Overall, it was on balance, maybe slightly dovish Fed, but certainly a Fed that continues not to give much away. And probably for the markets, that's not a fantastic thing. Certainly leans the markets in a direction where policy is more likely to be at the margins, a little bit more loose or a little bit more dovish than perhaps was believed before this particular FOMC decision.
Now, Kyle, the other events weighing for investors, clearly those tech results from Meta and also Microsoft, with very much a focus on capex, and increasingly there's concern there about those circular deals being done.
Yeah, the circular financing one's a little bit interesting, whether sort of it's fact or fiction, and sort of to what extent that will prove to be true. I sort of am skeptical myself of whether really what we are seeing here is sort of a circular financing. That's, I guess, a story for another day. But what we are seeing, I think, is a level of trepidation in the markets about artificial intelligence return on investment, certainly from the companies that reported last week, an increase in capex that is having this sort of depressing effect on multiples and weighing on market sentiment, if nothing else. And I think once we saw the Fed decision wrap up overnight, which, like I said before, overall was probably seen as dovish and actually being quite positive for equities. We saw the Nasdaq up by 0.5%, the S&P 500 in positive territory shortly or during and then shortly after the Fed decision, was that we had this kind of positioning then taking place for these results that we got after hours. And I think the markets are still sort of digesting the impact of the results from Meta and Microsoft because they were a little bit of a mixed bag. Meta's guidance was a little bit weak when it came to revenues. There wasn't an increase in capex though, so that's sort of perhaps on the positive end of the ledger. But Microsoft's results were actually really solid and actually proved a little bit of AI monetization with the stock mostly up after hours trade, despite actually increasing capex as well. So we've got futures bouncing back, unwinding some of that loss last night. But I suspect that, well, in the next 24 hours or so, we're also going to be waiting for Apple and Amazon's results. Apple less so of an AI bellwether, but still an important name, being, at least by my last estimation, the most valuable company in the world. So this kind of, again, nervousness about tech valuations and underpinning that tech AI capital expenditure is still really having this kind of dampening effect on market sentiment. And like I said, one of the reasons why we had that, sort of sell-off, quite aggressive sell-off in the back end of US trade.
So, Kyle, what can we expect ahead for the local session?
Well, I think it's going to be very much determined by what kind of geopolitical headlines that we get, and then off the back of that, whether the markets start to weight some of these results from some of these tech names positively. And so far, we have seen a bit of a rebound in US futures. So that suggests that as the dust settles, maybe investors are feeling a little bit better about at least the results coming from Microsoft and Meta as we sort of position now and look ahead towards Amazon and Apple. But one thing that you can say about the Fed decision, I think, is that it was more dovish than expected. The odds of a rate hike in September have gone down. And although we've seen a bit of a steepening in the yield curve as these kind of fears about persistent inflation maybe put some pressure on multiples and some really long duration assets, really the front end has dropped, the dollar is lower. In principle, financial conditions a little bit weaker, and that should be a little bit supportive for assets as well, especially in Asia, given, obviously we're so sensitive to yields in the US dollar in this part of the world. Of course, at a time where, there's all these concerns about even possibly a bit of systemic risk coming out of, South Korea and the volatility there. So it's very much going to be headline driven, and the rest of it's going to be digesting what we got from US companies and the Fed. So far, it looks like a little bit of a bounce, but it's going to be really one of those days where things will, trade moment for moment, moment to moment as investors, try to discount all of this information.